Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by the DNA of CRE. Yes, check it out, especially if you're in brokerage. Check it out. Just Google DNA of CRE. Well, today we're going to talk about single-tenant net lease investment properties. You know, and that's a wonderful sector for investors all over the country because there's not a tremendous amount of moving parts. You have very high credit tenants, real low default rates. And it's interesting to see what's happening with interest rates and cap rates and things impacting the single tenant net lease investment market. Please welcome my guests. We have Nancy Miller here. She's president with the Net Lease Investment Group at Bull Realty. Nancy, thanks for being with us.
Thank you, Michael, for having me.
We also have Tim Kinney with us. He's senior director with Marcus Millichap in their loan division, capital markets. Tim, thanks for being with us.
Thank you, Michael. Good to be back.
Well, first of all, I want to get to the elephant in the room to me, and that is on account of cap rates and kind of what you guys are seeing, and then really how are they trending? Are they flat? Are they compressing? You know, what do you see, Nancy, from your brokerage chair?
Michael, cap rates are compressing a little bit from 2018 to 19, primarily because interest rates have, and Tim will attest to this, have stayed fairly low. We're seeing across the sectors maybe an average of all the blended types of tenants, maybe a 6.5%, but then when you dig into different tenants, you see rates far lower or a little higher.
Interesting. How about from the lender's view? What are you seeing for cap?
Yeah, we're seeing it's a driver because interest rates are now at historic lows. So we've seen the cap rates compress, and then you just have that delta between your cap rate and your interest rate driving your cash on cash. So we're seeing them, and there's so much interest in single tenant net lease because of that. The other investments that you have to make, what's the alternative investment theory, where if you want to buy the 10-year Treasury bond is yielding 1.6% currently, and you're getting a cap rate of say 6.5%. We're seeing a lot of investors moving and then leveraging using the low interest rates.
And you mentioned that delta between the cap rate and the interest rate. What do you see in there normally today?
Well, and that's a good question. I mean, it just depends because it depends on the asset. If it's a investment grade asset, that's one thing versus a quick serve restaurant franchisee. It's kind of a wide matrix, Michael. There's really not a number on that.
Give me a sample for a dollar store interest rate today, because I guess cap rates on dollar stores are what, Nancy, around 7?
For triple nets, your Dollar Generals, they're going to be in the low 6s for a new 15-year lease, and the Family Dollar family is now double net leases, and they're going to be in the low mid-7s. There's a big
and an interest rate on a property like that?
I would say put a 4% handle on something like that.
Yeah.
Like our benchmark is the 10-year Treasury.
Yeah.
So we add a spread to that of, say, call it 250 basis points or 2.5%. So you're in the low 4s. 10-year fixed, 25-year amortization schedule.
Yeah.
And so that's a big driver.
Yeah, I mean, that's a nice spread, basically 3% between your interest rate and your cap rate, roughly. Really adds to your return, right? Well, what do you guys think about cap rates moving forward? What's going on in the world? What's going on with interest rates? What would you expect in your crystal ball?
You want me to go for it?
Sure.
Okay. I think that we'll still see continued bit slower compression. I think the outcome of the upcoming elections this fall will determine the future beyond a year from now, depending on which party's in the White House. I think we could see a slight increase in rates if the Democratic demos are in and the Republicans, it'll probably stay consistent or a little bit lower. Those are my thoughts.
You know, it's really interesting. I've been in capital markets for many years, and anybody who tells you they know what interest rates are going to do is So I would say we're in a new normal of low interest rate environment. You look at globally, again, with the benchmark being the 10-year Treasury, then you yielding 1.6% today. Then you look at the German Bund, which is a negative interest rate. So you have worldwide in the capital markets the huge bond market driving interest rates, and the European Central Bank and our Fed. So you've got, if you can invest and receive negative 4% or 0.4% versus a yield in the U.S. bond market at 1.6%, where is your money? It's going to flow. Money flows where it's treated best. So we're seeing enormous demand for our Treasury bonds, and that's keeping the yields down. Then you put on top of that the Fed. The Fed is probably not going, after dropping rates and keeping them down. Powell and the crew are looking to stay flat this year, and they're not looking to raise. And the big bogey is inflation. If we see where inflation is under 2%, they want to get it up to 2%. We're not seeing it, so we're looking at flat. And again, in my career, we're maybe 20 basis points off the all-time low of the 10-year Treasury. I would think that was 1.36. So now we've moved up a little bit here recently, but this year we're down in rates significantly, and the last year, if we're sitting here, the 10-year Treasury was at 3%. So where rates are going to go, I think we're going to just stay relatively flat here, and those are big economic world drivers that you got to watch.
And so then you would expect cap rates to remain fairly flat as well then?
Yeah, I mean, we've seen them kind of level off here, but I'm seeing these cap rates, 5.5%, 4%.
Well, if I can interject, I think that state by state, states that have no state income tax, for example, Florida, Texas, and several others, they historically have always, no matter what the interest rates are, a lower cap rate than states that do have state income tax. We also see that states in the Sun Belt, if you will, we're seeing the greatest preponderance of people who are buying from all over the country are buying south. And they're buying south, if you think about it, it's seniors are moving south. The economy in the South is really robust. So when that all happens, it's a supply and demand thing. So we will be able to sustain a lower cap rate because of the demand in the South, no matter what the interest rates do or no matter what the economy does.
Interesting. And what are you finding that's popular for industries right now from buyers, or do you want to kind of industries or tenants? What do people want?
The top tenants are one. Let me answer that. Your dollar stores, there are over 15,000 of those, and they are adding those. They'll add another $800 to $1,000 generals this year. Your other popular tenants, your drugstores, your Walgreens, your CVS's, again because of an aging population, they're top growing tenants, especially in the Southeast. Wendy's, your fast food, your QSRs, Taco Bell, those kinds of players, Popeyes, and so forth, because of the economy and because of growth here. Those seem to be a lot of the most popular types of tenants. Is that?
Yeah. Tim, what about from a lender's view? What tenants do lenders like?
It's binary, Michael. They like investment grade credit tenant, number one. You can see that we have a cadre of lenders that have little divisions, and all they do is lend on single tenant net lease. And so they'll have like an approved list. And so always at the top of the list are all the investment grade, triple B minus or higher rated by S&P. You have that group, and then you have maybe a secondary group like the Tractor Supplies, some other of the tenants that are not necessarily rated, but their financials are so strong. And so that's what the lenders like. And then when it comes to the dollar stores, it's interesting because of the supply. If you look at the aerial of a Dollar General and all you see is green, and there's no population, even though that's part of their business plan, that gives these guys pause. Is what they'll do then, they'll change their underwriting a little bit away from from the tenant, which is typically our focus, a little bit more over to the borrower and their net worth, liquidity, schedule of real estate owned, experience, wherewithal.
And how many of these loans that you do are sculpatory? How many of these personal guarantees by the borrowers, and how many don't?
You know, and that's a great question because we see a lot of partial recourse. So instead of having 100% non-recourse, no personal guarantee loan, a lot of this, our lenders are 25% recourse. In that world, the bank world that have the single tenant net lease divisions. When I get into the life company world, they're non-recourse, but they're lower leverage. And then
what's an example? 50% or 60?
60, 65 in there.
With the life insurance.
Yeah, and then for let's say a Walgreens or someone like that, 70% in the capital markets loan to value is standard, whereas in the QSR market or in the franchisee market, 65 is standard. And then the typical loan is 10-year term, 10-year fixed, high 3, low 4% rate, or even lower. I just closed on a CVS last Thursday in Woodridge, New Jersey. Cash out refinance, 50% leverage, 10-year fixed rate, 25-year amortization schedule, and the interest rate was 3.36.
Nice.
That's good.
So that was through a large bank in that area we work with a lot.
How much term was left on the tenant's lease term currently?
I want to say, if I remember correctly, they still had 14 years left, so it was down the fairway.
Okay. Well, excellent. So those are your sources, I guess, the life insurance companies and then the banks and any others?
Yeah, it's interesting. It's kind of an interesting matrix out there. You also have, don't forget about credit unions. And a lot of people like the federal credit union has no prepayment penalty by law. So some people like that. The rates are a little bit higher in that world. We still are seeing, on the larger deals, Michael, we're seeing commercial mortgage-backed securities. CMBS financing is still there. For people that want the non-recourse, 10-year fixed, 30-year AM. Excuse me. And then I just recently closed on a grocery asset, which had a new 20-year lease. And so we did a 20-year fixed rate loan, 20-year amortization schedule, self-amortizing for a couple of investors out of California, two brothers investing in a property in Chicago.
Was that a zero cash flow deal? Or
No.
Cash flow?
Yeah.
Excellent.
So we got the loan to value was down to about 60%. So they had some cash flow, but they just wanted to put that thing to bed in a trust.
Nice.
And not worry about it. And again, that was a life insurance company loan.
Now, the credit union funding sources, is that full recourse?
Yes.
Okay.
Yeah, absolutely. They're not a non-recourse. On certain occasions, at a very low leverage, they can go to the NCUA and get a non-recourse loan, but that's in very rare circumstances.
Okay. All right, we're going to take a short break. When we get back, I'm going to ask them about some mistakes that you really want to avoid when you're buying single tenant and net lease properties. They seem fairly straightforward, but the devil can really be in the details. And then we'll get some tips of how to increase returns buying single tenant net lease. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, creshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.